Hey everybody, welcome to the Thursday, October 9th, sorry, I was a little distracted there, Thursday, October the 9th, 2025, financial thing. I'm going to call it the investing live stream now because we don't just cover peer-to-peer lending here anymore. We're going to talk about many different things. Hope you're all having a great week. Thank you for joining and thank you for tuning in. Appreciate you. Let's talk about what we're going to talk about this evening or this morning, wherever you are, the afternoon here. I don't know if you see outside, we have a very slanted camera view, the outside of Casa del Financial thing. It is a gray and overcast, 30 degrees here. We have managed to avoid hurricanes this year, which has been good. We'll see if that continues. There's another one out in the Caribbean that looks like it's going to turn away again. We send all of our remnants to Europe. But yeah, it's a very pleasant day. What are we going to talk about? We're going to talk about some peer-to-peer things. Now, I have been getting a ton of emails recently saying, people are upset with peer-to-peer, with the investing. They're upset with Cufflink. They're upset with crowd property. They're upset. So I just want to kind of address some of these comments and just give you my 2 pennies worth of what I think is going on and where I think things are going. We'll take a look at what's going on in the stock market. Things are booming away, roaring, continuing. A lot of questions about that from friends and family too, saying, this is all going to end. This is going to be a disaster. Yeah, maybe. We'll see. Talk about that. We got a little prop lend update. We'll talk about some Bitcoin and a couple of letters from the mailbag that I got over the last couple of weeks. So we'll talk about that. Quick shout out to everybody out there watching. Please hit that thumbs up. If you haven't subscribed to the channel, please do so. A little 1 second tap of that like button really helps out the stream, believe it or not. Hello to Paul Bagworth. Welcome. Stephen Hale is here in Nottingham. Mark Mason, nice to see you, Mark. Dave Dawson is here. Paul New in Stockport. Hi, Paul, Stockport. Peter Vince Leatherhead and Lynn Well, number 1 is here. Thanks for joining. Appreciate seeing every one of you. Let's just get right into it, yeah? No point in standing on ceremony, as they say. I just wanted to take a quick look at the LoanPad account statistics. I do that for myself just as well as for you because I do like to keep up on what is going on with the old LoanPad. There we go. 5,244 total lenders. I don't know if that's really upticked much. 21 lending partners, 122.7 million total LoanPad loans, 43.95% aggregate lending partner share. So we got an average loan to value of just a little bit over 45%, 275 live loans. It's a lot of loans. Get your head around that. 275 loans, and still the average loan size less than £450,000, which I actually really like, that they don't have a much higher average loan size. And still, of course, estimated time to sell. Well, not of course, because that's never a guarantee. One day. Time to invest one day. The minimum is now for reinvestment no longer £10, so 1p, which is great. Every day you get interest. And the ICF, the coverage fund, is 0, so they have not using any money on bad loans. Look at this, 762 loans paid back Total value of repaid loans, 291 million. Those are big numbers. These are not small numbers. Okay. These are big numbers. PropLend sent out an update. I think we're going to see more and more of these updates coming, and I'm going to tell you why. This is a loan redemption update. In the past 10 days, we've received repayment of a number of loans, one long overdue, along with a number of expected as well as unexpected before their original maturity redemptions. This means that many lenders will have excess and unallocated funds in their accounts. And whilst this must be frustrating, having any loans repay is the ultimate customer outcome. We increased our borrowing team to 4. When Will joined us a year ago, we're actively recruiting another member of the team as we write. We've recently launched a brand awareness campaign to drive new loan inquiries, and this has been well received. Engaged with new brokers, and loan inquiries are up about 40%. Last month we saw our biggest month with £110 million worth of inquiries. Loans are only moved into pending once valuations are in. We're making good progress on legals and due diligence. We currently have $17.5 million in the pipeline, from offer accepted through to funded and waiting to close. And whilst not all of those loans will make it through due to the due diligence process to go into funding, we wanted to reassure you that the pipeline is healthy and strong. So, letters like this going out tell me that lenders are a little bit frustrated with the demand and supply of what is going on at PropLend. So there is more money, hence higher demand, than there are loans. It's a very difficult balance for a peer-to-peer lending company to get right, to have enough money to fund loans and to have enough loans so the money gets deployed and isn't sitting in lenders' accounts for a long time, creating cash drag. This is, I think, the most difficult thing about PropLend. Now, some peer-to-peer lending companies have the opposite problem. They can't get enough people to lend money to the loans that they have available. And PropLend is the reverse. It sounds like they have too much money from customers, like peer-to-peer lending customers, and not enough loans to put the money into. And they have a very difficult balance because they don't want to write bad loans just to get people's money deployed. In fact, if you are a peer-to-peer lender through PropLend, you would be glad to receive a letter like this because it shows that they are not just taking on everything they can. Hello, Lendy, funding secure, money thing. Do I need to go on? It shows that they are vetting the loans the way that they should be to make sure that they provide quality loans for you as an investor. That should make you happy. That's what you want to see as a peer-to-peer lender. So if you are frustrated because your money is sitting around, you can always move it. You could put it into a product like LoanPad, where you could leave it there short term and move it back when you need to, or you could just stay put and be patient. That's what I would probably do. So that did come through from them. Now, the other thing I wanted to address is, again, ever since Cufflink's announcement of the terms and condition changes, there's a lot of upset people. And what it has done, I think it's cast a bit of a dark cloud on the peer-to-peer lending space in general. Cufflink was one of the bigger peer-to-peer lending companies that most people had in good standing. And now that change in terms and conditions has kind of changed things. Also for myself personally, at this point, would I continue to invest money through Cufflink? No, I wouldn't, for a couple of different reasons. Number one, I was not very happy that those changes were dropped on us as customers so quickly. There's been a certain lack of transparency, I think, that is going on there. And then also, the second reason is the increase in defaults. And I said this last week, that there is never anything wrong with sitting on the sidelines and waiting to see what happens. I think that's the play right now with Cufflink. Until I hear something different, until I see these defaults start to decrease, which they're looking pretty hefty at the moment. 43%, I believe, is the number of loans that are having problems right now, I would personally sit on the sidelines. I've been doing so myself, like drawing down the balance that I had inside of Cufflink. And by the way, I've had also a couple of emails about what about the top 5? It's still listed on the top 5. I'm changing that next week. The top 5 is going to look different, and I will update the Cufflink review because it needs to be updated. Pardon my slackingness on that. So to everybody that's asking me, yes, I would sit on the sidelines right now, and things change very, very quickly in peer-to-peer lending. I mean, 1 month ago, 2 months ago, when Narinda was running the company, I was feeling pretty good about things. I mean, the default situation is not really what you want to see, but things change quickly. When those terms and conditions were dropped on us, it happened quickly. And so something that I would have said 3 months ago I'm okay being invested in now has changed. And that happened. Same with crowd property. When Mike Bristow stepped away from crowd property, I also got the same feeling that that's probably a time to sit back and sit on the sidelines. There's some people that are going to be okay taking risk and continuing on forward. Myself, I've been burned too many times by bad peer-to-peer lending companies where now it's the smart thing to do for me personally is to sit on the sidelines. And there are plenty of other places where you can make good returns and be comfortable doing it. Now, maybe those two companies right now are not the places. When you make an investment into peer-to-peer lending, you have to understand really what you're doing, right? These upstart companies are created by people that we don't know. Like, we can look at their histories. We can go on LinkedIn and see, what their history of employment's been like in the past. But essentially, you have a bunch of strangers that are putting together investment companies and then saying to you as a customer, would you like to invest? Would you like to get 8%, 7%? And we quite happily handed over our money to strangers and said, yes, we are okay taking that risk. But things change. Leadership changes. Companies that have done well in the past can flip-flop and do terribly and run into problems. Hello, money thing. Hello, funding secure. And honestly, humans make mistakes. You're a human. I'm sure you've made mistakes in your life. People running companies and financial investments, private investments that these are, they make mistakes and things happen. They make bad loans. These loans go into default. So you always have to remember when you're lending money through private companies, like peer-to-peer lending, yes, they may be FCA regulated, but let's be honest, does that really hold a lot of weight? Maybe, maybe not. Some of the companies that have gone out of business bankrupt were FCA regulated. So when you are thinking about, risk tolerance, remember you are handing money over to people that you don't know. You don't have access to the CEOs of peer-to-peer lending companies, just like you don't have access to the CEO of Blackstone. Same thing, right? You don't have access. There's just not as much transparency there in peer-to-peer. You're talking about a smaller niche of money. Now, also another thing, the stock market has been roaring ahead recently, and what that does when that happens, people become disillusioned with lower rate returns. So where you were happy to get 7 or 8% before when interest rates were bad and the stock market was kind of middling along, now people become disillusioned and they see people posting about stock returns being in the double digits for the last 3 years, and they want to get a better return. So they think, well, peer-to-peer lending, I'm only getting 6, 7%. I can go bung it in an index tracker and get 12%. What's the point? Why am I taking all this risk? Now, if we were in a bear stock market and things were going really badly, people would be flocking to things like fixed incomes, bonds, savings accounts, where they felt a little bit more safe. Even some of the peer-to-peer lending products that, I consider to be safer would be on top of people's lists because people are very short-sighted. They run to what is hot. Myself included, I'm the same way. I'm absolutely the same way. Sometimes I jump in and out of things. I'm a human being. all I keep seeing right now is stock market bull run, stock market bull run. You know, it's hard to swallow making 6 or 7% before tax, because I'm not in an ISA, when you can go shove it in the stock market and make more. Okay, now if the stock market starts to turn around, that feeling is going to become very much different. I'm sure you've had it too. I'm sure you've bought a stock or a share where you see it's been doing good, and then one day you have this massive downturn of like 6 or 7% in a day, and you start to feel your stomach dropping, thinking, maybe I should just sell this stock and get out of it. And I've done that before, and it's cost me some money. Peer-to-peer lending tends to be more of a safe haven in, bear markets. When the stock market is not doing well, you can turn to a fixed income product that you could potentially get a better return than you could in stocks and shares. Right now, we're not at that time, so it becomes more difficult to stay invested in something where you think maybe the risk to reward isn't really matching up. Now, I still continue to stay invested in some things in peer-to-peer lending products like LoanPad, like Unbolted, but my exposure has become less, right? I've started to draw down some of these investments that I have in peer-to-peer lending in search of different opportunities, and that's why I talk about things like that on the stream. This is not strictly a peer-to-peer lending stream anymore. If it was, I think we probably wouldn't have that much to talk about. For example, this week is the first week that I've been doing this stream for, 8-9 years now. This is the first week that the Alternative Credit Investor website has not had one story about peer-to-peer lending. That means there's nothing to report. It's a pretty dead news place at the moment. People are looking for other ways. I think that it's important to, just to reevaluate your risk tolerance when things are not going well in a certain sector. Say, do I have the risk tolerance to suffer a loss? And remember, you are going to suffer losses eventually. I think with any peer-to-peer lending company, I think it's just a matter of time. Some of them have been really good, but it'd be unrealistic to say, I don't know anybody in peer-to-peer that hasn't suffered a loss at some point. So you do have to factor that in and just reevaluate, what your risks are. Just quick housekeeping. I don't remember if I said this last week, but I had to move the date for the Fourth Way live to October the 23rd. So it was originally supposed to be next week on the 16th. That's going to be 7:30 p.m. UK time. I don't know, the time clocks change on the 23rd. Let me Google that. When do UK times change? 2025, October 26th. Okay, so no, it will be 7:30 p.m. UK time. Neil Faulkner from Fourth Way is going to be here, coming, I think, live from Germany. So I'm really looking forward to that conversation. I want to ask him, kind of his thoughts and feelings on what's going on in peer-to-peer in general, because I do see a lot of negative sentiment. Even, on the forum, I've just been reading on the Cufflink forum, and I just don't see a lot of happy people. This does not bode well for Cufflink because, rumors and news, it spreads quickly. And I think there's a lot of disheartened people out there. I don't blame them. Things, what do they say? All good things come to an end. I don't know if it's coming to an end with Cufflink, but I think they're going to lose some customers over this. And that is kind of sad. Let's have a look at the Fourth Way article on Cufflink. Bad debts and how do recent changes impact lenders. We've had a loot of emails from lenders about recent changes at Cufflink. So I just want to kind of go through this and share my views. It says, combined with Fourth Way's constant flow of detailed data, and I don't know if you know how Fourth Way makes money, but basically they have peer-to-peer lending companies pay them. So say, for example, Cufflink pays Fourth Way and provides them with data, and then Fourth Way is able to give a review. And the idea behind that, and it's kind of a unique idea, is but if a peer-to-peer company is doing well and they're transparent, they can provide all of this information to a company like Fourth Way and expect them to write a good review on that company. That kind of makes sense. So what that does, in my opinion, is the bad companies are not going to do this, because why would they pay Fourth Way to give bad information? That would make no sense. So Fourth Way focuses on what it believes is the good companies. Now, is it always accurate? Probably not. But I think it's an interesting way to do things. How about the debts now? From the recent changes, for a moment, the bottom line in bridging and development lending is always this: our borrowers were paying, and if not, our bad debts being recovered. Cufflink calls a loan default the very first day it falls late for repayment. On that basis, total outstanding bad debt is £87 million. Okay? The FCA has a bit of a looser definition of default. So in their definition, it's £73 million of bad debt going through recovery procedures. By the way, recovery procedures are very expensive legal-wise. Anybody who's ever hired a solicitor knows this. So we're talking about, even on FCA's looser standards, 73 million out of 170 million. 43% of outstanding loans are bad. That's £43 in every £100. This figure is a little inflated because Cufflink grants fewer official extensions than we normally expect to see in bridging loans. It continues to talk about the older loans. 38% turned into bad debts on day one late. Given the battering business property owners have taken in the recent years, today's higher proportion of troubled loans is reasonable, well within Fourth Way's forecast for stress conditions. What do you think about that? Is 43% reasonable? I think it's really high. I'm not sure that would be considered reasonable. If you look at a company like LoanPad, right? If it was 43%, you'd be I would say more than a little bit concerned. I think it's way too high. I would like to see that number in 20%, I don't even want to see 20%, but 20% I could stomach. 40%, 40 plus is difficult. Analysis of the outstanding bad debts. Most of the bad debts, look at this, tens of millions of pounds are held in Cufflink's auto lend accounts. They come from just a handful of very large loans. This is the most, I think, distressing thing about the default situation. The fact that most of them come from a handful of very large loans. So if one of those loans really does go bad and they get some bad recoveries on it, it's really going to hurt the overall loan book. That's a lot of risk in just a few loans. This is sometimes called granularity risk, a few large units in a portfolio that create outsized risks. This is one of the reasons I like LoanPad, because they're keeping that granularized risk to a point where it's manageable with the like the 443,000 average loan size number. Going back to this, it's not ideal that all the largest outstanding bad debts also happen to be supersized loans at the time. That's unlikely to be chance, and suggests Cufflink was right to cut back sharply on very large loans about 18 months ago. Still, it's understandable larger, more complex loans take longer to resolve when they go bad. Well, how about this? How about not writing bad loans on larger loans? Right? That would be the smart play. Anyway, it says progress is happening. Some loans have already been partially paid down. Further development being funded by Cufflink itself. Or Cufflink calling in additional property security from borrowers. I believe Cufflink's claim that most of these loans still have very good prospects of full recovery. Fourth Way assessed the smaller outstanding bad debts, collectively several tens of millions. So far, they look no worse than usual risks in Cufflink's flavor of bridging lending. The head of collections believes one or two or three loans will fail to fully recover. Most should be resolved in 12 to 18 months. That's the firmest forecast Cufflink has ever given. It will be revealing to see in 18 months whether recoveries matched expectations. One of the things that also concerns me about these defaults is the state of the UK property market. I spoke with a close friend of mine who is a RICS surveyor, who said that he believes that the UK is going into a property recession that is going to become quite nasty over the next 12 to 18 months. If that happens, these recovery prospects could be maybe worse than is initially expected. Recent changes made by Cufflinks, we all know about this. Cufflink stops covering losses itself. There's obviously people that are upset. This is being put on previous loans and not just new loans, so terms and conditions were changed on that. Cufflink has paid $1.6 million to cover bad debt over the years, just 0.4% of its historical loan book. It was never obliged to do this. I think it would have to do it in some ways, because if they did not and people were taking losses, it would have been hard for them to continue to gain the trust of those customers continuing to invest into Cufflink's loans. After auditing its products and processes, Cufflink has decided it won't cover lending losses again. Why is that? It's sensible to wonder whether this timing suggests looming write-offs, but I've seen no evidence of that. Cufflink's stance is that bridging and development lending is risky and lenders must accept that. I think that view has merit. Fourthway has often said you need to be confident that the rates and underlying risk of the loans are satisfactory, and any pots of money that are offered by P2P lending companies to cover bad debts should usually be seen more as a little bit of icing on the cake. Cufflink has scrapped its 5% first loss on every loan. You know, it's an interesting... and again, this goes back to transparency, how we really just don't know. Like, did Cufflink scrap its first loss because it knows that they won't be able to cover these 5%? And is that why they put it onto backdated older loans and not just new ones? That's a really good point that we just really don't know the answer to. And I think anybody of any bit of intelligence would probably look at that and go, well, yes, that's maybe a good reason why. But the second point, I think, has merit, that you are taking risk to get your percentage earned. I think the one-year product, like 9%, you're going to take risk. So you got to take the risk of that bridging loans going into default and recovery. You have to be prepared to take the loss. Key factors with this 5% stake, first loss scrap: the properties backing the loans, the ability to exit projects and sell properties, Cufflink's ability to recover bad debts. So those factors will remain the same. Cufflink won't cover any losses out of pocket anymore, but it's still funding troublesome ongoing developments. It now rarely funds development projects, especially large ground up ones, but I've been told it would still consider funding difficult developments to completion on a case-by-case basis if it considers it the appropriate way to deal with it. So what that is saying is loans that are going into default, that Cufflink is funding some of those bad loans to get the builds completed. My guess on that one is if it looks like they're going to lose money on it, they're not going to fund it. I guess I can understand that. And the ones that they see they have a good stake and a good position in, that they feel like they're going to be able to make money on, they'll fund those loans to completion. Interest is only paid now to lenders, if the borrower pays. They've removed interest top-ups or internal subsidies, so Cufflink will no longer pay you interest if the borrower doesn't pay them. For many lenders, it was news to them that they ever did a top-up on your interest when borrowers fell behind. It was never a contractual obligation to you. They've only ever done it for 3 loans. Now you're paid some additional interest in default. Lenders will receive 0.25%, or 1/8 of the additional default interest. So borrowers typically pay Cufflink 2% extra per month from as soon as they fall late. That's hefty. 2% a month, right? So imagine if a business goes 12 months, they're going to pay 24% interest when you're only going to get 3% of that. So out of the 24%, Cufflink is going to get a big chunk. That's very interesting. Cufflink's recoveries records have been phenomenal. So it says. So Cufflink says any possible losses are small compared to historical earnings. Anyone new to Cufflink's auto lend product doesn't have the advantage of past earnings if any hits need to be taken. Nevertheless, over the life of the auto lend term, the losses versus interest are likely still very well contained. Cufflink expressed the view that lenders who panicked and withdrew after announcing the changes were not suited to this type of investment. That's an interesting comment. I'm not sure I like that. I wonder how many people actually panicked and sold. I think that's harsh. But yeah, again, as Forthway pointed out, if you're easily stressed or worried about investing or uncomfortable with risk, tend to make snap financial decisions on hearing news that sounds bad, you should keep more cash in safer accounts and less ones in riskier products like this. This is why I say, if you're not comfortable, you can exit. And I don't think that's the wrong way to do things. And it also depends like how much money you have invested through Cufflink. If you got tens of thousands of pounds and it's a big chunk of your net worth, you're probably going to make a different decision as to somebody who just has a couple of £100 in there, does it as a little side investment. So, Cufflink and crowd property really heavily on my radar right now. The problem is we're not going to see much change, I don't think, for several months. So this is going to be a really sit back, wait, and see what happens and hope for the best. I hope this isn't going to damage Cufflink's business too much. We all win if Cufflink wins. That's the end of the day. And some of the insider things that I've been told do make me a little bit concerned. I really can't go into that because obvious reasons. I'm not trying to get sued or anything like that, but there are some concerns that I have there about the way that the company might be being run by the people that have taken over. You didn't hear that from me, though. Anyway, that's kind of what's going on with Cufflink at the moment. I think they would have to come off the top 5 list at this point. Maybe they'll come back on in 6 months to a year when they got all of this stuff sorted out. Who knows? Wait and see. Moving on. Vanguard has slashed fees on 6 of their exchange-traded funds. We're going to talk about some investing stuff now. Move away from the peer-to-peer lending because there really isn't much else to talk about at the moment. For decades, Vanguard's reputation has been an ultra-low-cost share-friendly investment strategies. Many of Vanguard's ETFs and mutual funds are among the cheapest in the category, including the S&P 500 ETF, VU, and VTI, which I personally own, both priced at just 0.03% annually. That's crazy. It's such a low fee. Despite this, Vanguard is looking for opportunities to go lower. How could they? In February 2025, Vanguard announced one of the biggest fee-cutting sprees in history. It reduced the expense ratio on 87 of its funds, saving investors an estimated $350 million in fees annually. Competing with Vanguard on cost isn't easy. They have decided to slash fees on 6 more of its ETFs. Let's see, 6 European ETFs, the half dozen ETFs that are getting their expense ratios cut in this round come from the Euro markets. We got Vanguard's FTSE All World UCITS ETF. That's being cut from 0.22% to 0.19%. Vanguard's FTSE North American ETF, 0.1% to 0.8%. Sorry, 0.08%. What else? This one's getting a 5% cut. FTSE Emerging Markets ETF. And the emerging markets all cap 0.24 to 0.19%. The Japanese FTSE ETF 0.15 down to 0.1, and the German all cap 0.10 down to 0.07%. So Vanguard gets cheaper and cheaper and cheaper. And that's a good thing for you. Let's take a look at the Trading 212 portfolio. Risk on right now. 30,975 UK pounds at a total rate of return of 437.5%. making me look like a genius when in fact I am absolutely not. Look at this, NVIDIA up 92.74%. We're going to eclipse this $200 per share soon, I'm sure of it. So yeah, good result there. Strategy kind of struggling. Bitcoin has been all over the place. We hit an all-time high just a couple of days ago, only to go back below 121,000 US dollars. MicroStrategy getting a little bit punished because of that. Long-term, not worried about it. Not financial advice. Iron, this is a popular internet stock right now. Up 37%. This just shows you how even a bozo like myself can make money in the stock market with taking a little bit of risk. Just going to look at the history of when I actually bought these shares. Let me go to the history, because I can't even remember, but I know it was recently. Iron, look at this. 2nd of October. So 7 days up 30-something%. This is so ridiculous. I mean, we are in the fully fledged bull market. Look at this NVIDIA dividend. 34p. I do ask, what is the purpose of that? I don't really understand it. But there you go. But yeah, Iron, well, actually started on October 2nd. Did I buy before then? Okay, September 25th is when I started buying Iron. There you go. 1,500 pounds purchased on September 25th, so it's done pretty well. Let's go back to the portfolio. Amazon ticking away. I mean, it's kind of slow and steady. Probably not really right for this portfolio. Maybe I get rid of some of that. Tesla even up still 18%. They've released their new cars. I don't know if you've seen that, but recently, just a couple of days ago, announcing these new cheaper models. You can pick yourself a Model 3. They call it Standard now in the US. They have Standard and Premium now, so there's stripped back versions of the Model 3s that still get 323 miles of range. You can get yourself one for £299 a month. So whether these new stripped back cars are going to make a good addition to Tesla's fleet, I have a feeling these are going to be for things like rental cars, maybe when they start releasing the robo-taxis and things like that, but we shall see. So Tesla's still ticking along. It's down a little bit today. We've had kind of a red day. Our Vanguard S&P 500 has been trimmed, now 15% in the green. I did sell off some of that to enter into a position of another internet stock, which is gaining a lot of popularity now, Nebius, which I did, by the way, own at $100 and then sell at $110 mistakenly, because I'm a human being and I do make mistakes. So Nebius operates a tech company that engages in building full-stack infrastructure to service the global AI industry. So anything with AI nowadays is what people are moving into. Photronics, this was a new position to the portfolio, 1,500. I was going to put a little bit more into there, try to sell off the rest of this S&P 500 fund to add to Photronics and maybe even Iron. I don't know. We'll see. But that again is a semiconductors, photomasks that are used in the manufacturing of integrated circuits and flat panel displays, and to transfer circuit patterns onto semiconductor wafers. Some things I don't understand, but I took a position on that. And then Robinhood, the US stock market trading platform, which, trust me, every young person in America uses. They have a ton of good products, 8%. Although they are a bit naughty, they shut down their trading platform at times when things get crazy onto certain stocks where maybe liquidity is a problem. I don't know. But Robinhood still gains favor in the market. It's the %1 preferred stock trading platform that's free. You don't have to pay any commission to trade stocks on it. So we're up about 8.18%. So this completely degenerate trading portfolio that will get more degenerate as this bull market continues to go onwards, is doing pretty good. So we're almost again eclipsed. We did eclipse 31,000, I believe. Did we? Did we ever go above it? I thought I did. Maybe it's its all-time high right now. I thought it went above 31,000, but it hasn't yet. So maybe we're at the all-time high right now. This is historic. Screenshot it. Please, this is not financial advice. Do not follow what I am doing. Speaking of the stock market, I like this poach. We're approaching the 3-year anniversary of this bull market. October 12, 2022 is when we bought them 3 years ago. Imagine that, 3 years. The S&P SPX is up 89% since then. Historical statistic, the average bull market since 1950 tends to gain 192% in the last 5.5 years. So we're in year number 3. Out of the 7 bull markets that extended beyond year 3, all saw further gains during the following year. The previous 10 bull markets, 7 of them extended beyond 3 years. So do we know if this bull market is going to continue? No, we don't. Here's an interesting chart from 1950 onwards, showing you all the green and the red days. So if we look at the last 5, since 2019, the last 6 years, we had plus 31%. This is the S&P 500, plus 18. 2020, plus 28 in 2021. Then we had that bad year of 2022. Everybody thought the sky was falling. This was the beginning of the end. Minus 18%. Rebounded in 2023 and 24 with a combined total of close to a 50% gain. So, I mean, just look at this. The last, God, it was since 2003, we've had 1 red, 2 red, 3 red years in 22 years. 3 red years. Kind of crazy. Yeah. Anyway, I had an interesting email. Where is it? Here we go. This email made me laugh. I'll talk a little bit more about stock stuff too. Lawrence, I seriously think you should stop talking about Bitcoin. Bitcoin. On your live stream, I think it's a bunch of valueless twaddle. Maybe I'm just an old fart who doesn't know any better. Why do you like Bitcoin so much? I still like your streams. BW, Terry. Thanks, Terry. Well, first of all, Terry, I guess I talk about what I feel like talking about. Why do I like it so much? Okay, true story here. There's a couple of things. So, a couple of weeks ago, I was watching this video. A guy from Lebanon. It's a really interesting video. Maybe I'll post it in the description. But he was talking about when he lived in, I think it was Lebanon, somewhere like that, one of these Middle Eastern countries. He says there was a run on the banks. Hang on. There was a run on the banks. And he went to the bank to withdraw all of his money. And the bank said, no, you cannot get your cash. We're keeping it. The bank took the money, everything. And they did this to many, many people. So it sounds a little bit far-fetched, right? Especially for people that live in places like the USA and, the UK. But over the last week, my Lend Invest account has been locked out. And I have not been able to access that account now for a week. Because Lend Invest is mad that I did not put down a mobile phone number on my account. Or either that or the one that I had on there is not working because I go back and forth between the UK and the US. I don't keep my UK phone number on, blah, blah, blah. So I emailed them and said, this was back on last week. My account's locked out. I'm in the US for a couple of months. Please, I'd like to get access to my account. They send me a message back saying, how long are you going to be in the US for? The reason they do this is because if I tell them I'm going to be here for a year, which I'm not, but if I tell them that, they're going to say you can't have a Lend Invest account. To do with US and UK problematic relations with the regulations and how the UK doesn't like anybody that is a US taxpayer to own any type of investment account in the UK. Fair enough. Problem is, I've asked them several times. I emailed them again today and said, when are you going to resolve this? I told them I'm going to be in the US until January. When are you going to resolve this? And zero response so far. So this has been over a week. Actually, it's been over 2 weeks now. So I remember trying to log in, I think 2 weeks ago, to my LendInvest account, not being able to get in. So I'm locked out of my account, have no access to money. Thankfully, I don't have a lot of money in there. So Terry, when you ask me, why do I like Bitcoin so much? This is just one simple reason why, because I can control the funds. If I have money in a bank account or into a stock trading account or any other form other than holding something like a gold coin, I have zero control that if that entity decides they want to close my account, take everything, they can do that. Is it likely in the UK? No, probably not, but I have no idea. I mean, let's look at Germany in the 1930s and what happened. Let's look at some other countries and what's going on there. It could happen. There is a % chance that it could happen. I don't know what that percentage chance is. But that is one of the main reasons why ever since 2016, I started looking at Bitcoin in 2015 onwards. I said, yeah, I like something that I can control myself. Of course, that comes along with risks. Absolutely. But case in point, am I going to get access to that LendInvest account again? I don't know. I would like to think so. But could it happen that I don't? Sure. They could never email me again. I could go to the financial ombudsman, make a complaint, go through the motions. But I shouldn't have to do that. I shouldn't have to not have access to my money. That's not right. So there you go. I also like the fact that limited supply, 21 million Bitcoins is all that will ever be created. Can't print more of them. And we've seen what's going on with the debt issues in America and in the UK, printing more money, causing inflation, creating a kick the can down the road problem that is never going to be resolved. And inflation will happen again. This is why I like Bitcoin. And no, you are not an old fart. I think it's okay to ask questions, but I've sometimes I'm a little cautious to say things on here because I don't want people, going and making decisions about what I tell them to do. Because what am I? Just some guy who stands on a screen for an hour a week and says, "This is what I like. This is what I don't like." But there you go. I like it. I see a lot of positive things coming out. There's an article this week. Central banks will end up holding Bitcoin in their reserve, even though it is backed by nothing. Deutsche Bank predicts it doesn't need to be backed by anything. Deutsche Bank predicts that Bitcoin could be added to the central bank reserves by 2030 as its volatility falls and its behavior resembles gold. That's not going to happen. Bitcoin's volatility is not going to fall. But when you see stuff like this, it's kind of giving you the signs. This is obvious. Luxembourg claims bragging rights as the first Eurozone nation to invest in Bitcoin. They've put 1% of the nation's sovereign fund, which is about 73 million, into Bitcoin ETFs with a plan to buy and hold. This is a very small country. They have a 730 million US dollar pool of assets in the sovereign fund. They're going to deploy 1% of that. Is about 7.3 million. There you go. Interesting news. Global crypto ETFs attract, get this, close to $6 billion US dollars as Bitcoin scales new highs. You're going to get a chance to be able to invest into crypto ETFs in the UK soon, I believe this month. BlackRock will release one. A record inflows this week, obviously, as we see Bitcoin trended up to 126,000 and then had a bit of a pullback, but there is a lot of money inflowing into these crypto ETFs. US 5 billion, Switzerland $500 million, Germany 312 million. Bitcoin attracted 3.55 billion out of all of that. So some other shite coins too, Solana and XRP, with 706 million and 219 million. A lot of money going in. We're talking about a multi-trillion-dollar market now. This is not some flash in the pan. Another mailbag question. We'll kind of run through this real quickly. Hey, Lawrence, I have some money in stocks, index trackers, some NVIDIA, Tesla, and Coinbase. I'm afraid the markets are about to go down. My dad has been telling me to sell everything and sit in cash as it's the safe bet. I don't know what to do. Any advice on what to do would be appreciated because I don't want to lose everything. Thanks, Andy. 32 years old. Andy. Oh, my God. The amount of times I get this question, you're not going to lose everything. You're just not. Okay, if you had all of your money in one stock, like Coinbase blew up, yes, you could lose everything. But if you have index trackers, you're not going to lose everything. Look at our trusty index tracker right now, by the way. Our U.S. Index Equity Vanguard tracker, 1,125 pounds. A 50p, 52-week low, 864 pounds. You could have had your money sat in here and just done nothing and made, what is that, 10%, 11, 12%. But you're not going to lose everything. You're just not. Let's go back. Where's the earliest we can go back? Let's go back. Can we go to 2002? Let me go back. Oh dear. Let's go back to 2009, June. It's the earliest it goes back to. Of course, they put me at the... Let me change this because I don't want to look through. Let's go to December. No information. Of course. Why would you give me information, right? Let's go to 2010. Make this hard on me. April. Come on. First. Nothing? Okay, you're not going to give me any information. Let's try this again. Okay. So I guess I'm going to have to scroll through. Let's go back 5 years. Maybe it'll show me that. Okay. Now you're going to make me click. See how quickly I can do this. This is taking an advantage of skills from the old school video game at the arcade track and field where you have to press the button as quickly as possible. Don't open that. Nope. All right. Anyway, look, even if we go back to 2022, you can see here the price has just been appreciating all the way, continuing. We're almost there. Go back. January 2020, 532 pounds. This has never gone to zero, nor there is a 99.99% chance it will never go to zero, so you're never going to lose everything. And as that tweet showed, we're in year 3 of the bull market. These bull markets can go well beyond 3 years. Who knows? Nobody knows. It's all about sentiment. Could change tomorrow, but if you're 32, you have 30 years before retirement, give or take. So you don't really have that much to worry about. Buy and hold, my friend. Buy and hold. I think the markets are going to go and continue to do well. I wanted to tell you that don't listen to other people. You've got to formulate your own opinion, research. Like, look at these numbers here on Vanguard's website. You can make some very serious mistakes making the wrong decision. I did so on this gold decision that I used to hold. Spider Gold shares back in 2022. I sold out in September of 2022. I was recommended that this would be a good position to get out of. I got a little bored of seeing gold doing absolutely nothing, because you can see right here from October 2022 to here. That's 12 years. Look at that. 12 years of nothing in gold. And I sold out. And then look what happened. Tripled. 149 to 3. Well, not quite triple. Double. 149 today at 365. But sitting here and then sitting on one's hands doing nothing, that's not fun. When you're seeing everything else boom and go up. So they say dead people make the best investors. If you're long term, I'm sure if you look back in 30 years and you do nothing and just keep what you have, or even just put it all in the index tracker, you're going to be fine. Don't make the same mistakes I've done. I've sold out big portions of portfolios and not gotten back in and missed out on big upticks. Yeah, you don't want to do that. Don't do that. Andy, just, yeah. I don't know what your positions are in these other NVIDIA and Tesla shares, but your index tracker, you're not going to get rich from it, but you're not going to do anything wrong, and it's not going to tank 10 or 12 or 15% in one day like these ones can. Yes, I do have some positions in Tesla and NVIDIA. I've owned Coinbase before, but do it so in a diversified, proportionate way if you're going to do that. Stay the course, look at history. It's the best way. There is a lot of money sitting on the sidelines also. Look at this, a total. This is approximately in U.S. savings accounts, $10.85 trillion of cash. What happens if the market corrects itself? A lot of this money is going to get deployed into equities and shares, and the market's going to go back up again. That's what's going to happen. Same in the UK. Nothing different there. Look at the interest rates. They are dropping. This is in the US. It's going to follow suit in the UK. It's dropping. It's gone up and up and up, and now in a savings rate, you're going to get about 4%. As that starts to decrease, more money will get deployed into shares and stocks because people aren't going to want to make 3.75% in a savings account when inflation is over 3%. Doesn't make any sense. I think that's going to do it. We're at 3:27. I hope you enjoyed the stream. Yeah. Hope you enjoyed it. I enjoyed it. Yeah, hit that thumb. Oh, God, look at my hair. It's crazy. Hit that thumbs up if you can. Oh, it's hard doing everything in reverse. Do you have a good hair side and a bad hair side? I do. Anyway, yeah, hit that thumbs up. Subscribe. Tell your friends and family about the stream. You know. Film Call Limited is here. Hello. Invest24. Hello to you. Propland has been solid. Dave Dawson said there are better investments on stock market right now. Yeah. Could be right. SG 1009, welcome. Seems that cash from defaulted loan goes into your general wallet, not staying with you in your ISA too. Oh, I didn't know that. Oh, we're getting stock tips here from Dave. GCP Infrastructures Investments Limited. I don't know anything about that. I'm looking into venture capital and private equity investments on the Wealth Club. Be careful. Be careful. Dave says, I like trackers with the feel the S&P is a little frothy. There's always, now people have been saying it's been frothy since 2023. Depends how much risk tolerance you have. A lot of stock tips in the chat. Yeah, there you go. So anyway, we got to get out of here. It's almost 8:30 p.m. UK time. You got to get to the pub. You got to cook your dinner. Go get your roasted potatoes. I've got to go. And one thing, I will not be here next Thursday. Probably next Friday, because I have something I have to do next Thursday. So we're gonna switch to, I think, Friday. But come on the also on October 23rd. Neil Folker of Fourth Way. You have a great night, everybody. That is all I got for you this week. Take care. Much love. Thanks for tuning in. See you next time. Bye-bye.